In this video, I'm going to explain how the mortgage interest rate changed over time in the Canadian housing market and what factors affects the fixed and variable rate mortgages in Canada. Hi, my name is Ahmed Mahian and I'm a certified financial planner both in Canada and US. To understand how the mortgage rate changes, we need to first understand how the bank funds this mortgage. Now, typically there are two ways the bank funds this mortgage. Number one is by using their own funds. So you and I, when we have our checking account or savings account, or we might have our GIC with the big banks, are not going to keep all the money on their balance sheet. Typically, they're allowed to lend out a significant portion of our money to this mortgage borrower. The second way they fund these mortgages are through investors' money. So when a financial institution don't have enough of their own funds, they go to the bond market and ask for money from the investors. So these investors might be different types of pension fund, for example, Canada Pension Fund or Government Pension Fund or Teachers Pension Fund and different types of other investment funds. Sometimes if you are investing through the bank's mutual fund, you probably will also invest a little bit of your money into this mortgage. Banks typically goes to the bond market and ask money to these investors, and these big banks give a percentage to these investors as a return. Now, some small firms don't have their own money, so they raise their own fund through this bond market or different types of mortgage-backed securities program. Now that you understand how the bank raises money, let's take a look at the other side of the transaction. So bank acquires those money from investors or from their own fund. Now they're going to lend out these funds to mortgage borrowers at a higher rate. Let's assume that the big banks acquired those funds at 3% and they are lending out money to this mortgage borrower at 5%. So those 2% difference that the banks are charging, that's their profit rate. And that's how the big banks makes money. The banks will always lend out at a higher rate than its cost of funding. So what exactly goes into the cost of funding? The cost of funding is going to incorporate the cost of acquiring those funds. For example, if the bank is giving any interest to those depositors in their savings account or their GIC, that is actually costing the banks a little bit of money. So that goes into the cost of acquiring the funds. If the bank is raising the fund from the bond market, they have to give return to those bondholders. So those interest payment or the coupon payment will be the cost of funding for the banks. Now also, bank has its own operational cost. For example, normally you meet your financial advisor at the bank, they typically do your mortgage, or if you are meeting with a mortgage specialist at the bank, they also works as a commissioned employee. So banks needs to pay those people and they are costing a little bit of money to those banks. So the operational cost or the employee cost also goes into the cost of funding. Now, some banks don't have their own people and they work with something called a mortgage broker. So mortgage brokers are typically independent people. They get paid commission only when they fund a mortgage. So if somebody is making 1% commission to sell a mortgage, that 1% commission also goes into the cost of funding for the big banks. And then the other fees that the banks might have is underwriting cost. For example, somebody has to approve the mortgage application and they need to be paid by the banks. Sometimes they have a servicing department where there are a customer service employee employed by the big banks who takes care of the mortgage renewals, or if there is any change that needs to be done. And there is employee that are going to do those kind of services. And then the other cost that the bank might have is different types of advertising or promotional cost. So a lot of time you get cashback from big banks, and that also goes to the cost of fund for the big banks. Now that you understand what are those factors that goes into the cost of fund, let's take a look at how this lending rate and the cost of fund changed over time in Canadian history. From the chart, you can see the red line is a 5-year bond yield. What that means is when the bank is going into the bond market and issuing a bond which has a 5-year duration, the bank has to pay 3.66% to its investors. So the investors are asking for 3.66% rate of return from the big banks. So that's basically the cost of funding for the banks. Now, once the banks acquire those funds, they're lending at 5.58% rate to the mortgage holders. And that 1.92% spread is what the bank is making on that mortgage. If a client is getting $1 million mortgage, the bank is going to make 1.92% for that mortgage. Now, I'm oversimplifying the math, but you have to also include the cost of other operational costs that the banks have. I already explained that they have to pay their salary for their employees, or they might have the marketing cost. So when you are seeing 1.92% spread, this is exactly not how much the bank is making. The bank is actually making much less than that amount. But this is the gross spread you can see that the bank is making, because 3.6 is the cost of funding when they are raising money from the bond market, and 5.58 is the interest rate that they are making from that interest. Now let's take a look at how this spread changed over time. As you can see, right now in February 2024, the spread on 5-year fixed rate mortgage and the 5-year bond rate is 2.04. And if you go back a little bit last year, you saw times when it went up to almost 2.5%. That means the bank is keeping a bigger spread, and I'm going to explain why they are keeping a bigger spread. But if you go a little bit backwards, 2022 or 2021, you can see that the spread at that time for these 5-year fixed rate mortgage and the 5-year bond yield is actually between 1 and 1.5. That's because the housing market was very hot and there were a lot of demand from the customer. So at that time, banks were making a lot of transaction, and that's why there were greater liquidity and banks were more comfortable keeping a smaller spread. At that time, the housing market was much more stable than as in 2023, when the spread widened just because the housing market was going through some challenging time. So you can see the spread between 5-year fixed rate mortgage and the 5-year bond yield constantly change, and these changes happen because of number of factors. So these factors might be the competitiveness among all the big banks. If Bank A is lowering their spread because their cost of funding is lower, then other banks also needs to keep a tighter spread just to be competitive in the mortgage market. Other factors that also impact this spread is inflation rate, job market, GDP numbers. All those economic data goes into that spread. And as the bond market trades every day, every time there is economic data published in the news, they move the bond yield. Other factor that affects this spread is the cost of funding and the liquidity of the fund. So if the bank has lots of free cash in their books and they don't have to pay a lot of interest to its customer, then they're allowed to lend it out at a much cheaper rate to its mortgage borrower. And that's how they can keep a tighter spread and still make money. All of this goes into that spread, and the big banks keeps an eye on how much they should charge based on these factors. Now, we all know that there are two types of mortgage in Canada. One is fixed and one is variable. Now I'm going to explain what factor goes into the fixed rate mortgage and what factor goes into the variable rate mortgage. When you walk into a bank and ask for a fixed rate mortgage, they will probably give you rates on 1-year mortgage, 2-year mortgage, 3-year mortgage, 5-year mortgage, and sometimes 7 and 10-year mortgage. Now, most Canadians choose 5-year mortgage, and that's the most popular one. And as you already seen, that the banks borrow the money from the bond market and they are giving 3.66% to the investors and charging 5.58% to the mortgage holders. That's how they make money. So let's say you want to have a 3-year fixed rate mortgage. The bank will typically look at the 3-year bond yield, and then they will add a 1 to 2% spread on top of that bond yield, and then they will quote you the mortgage rate for that 3-year mortgage. As you can see from the chart, the 3-year mortgage will follow the 3-year bond yield, the 5-year mortgage will follow the 5-year bond yield, and 1-year mortgage will follow the 1-year bond yield. And I'm sure every time you look at a fixed rate mortgage, it is just going to follow whatever the bond yield on that same maturity. So if you are getting a 5-year mortgage, it will follow 5-year bond. If you're getting a 3-year mortgage, it will follow the interest rate on 3-year bond. So I'm sure you get the idea. Normally, they don't change their mortgage interest rate every day. There are a few reasons for that. It's just because if they start changing their mortgage rate every single day, it will be very difficult for its employee and sales force to keep up with those changes. So normally they only change their mortgage interest rate when it's outside of a band. Last year, the mortgage rates were pretty unique because the rates were changing so fast. So the big banks were changing their interest rate quite frequently. But if you go back a year or 2 years ago, normally banks change their mortgage interest rate every few weeks or maybe every few months. But if the bond market is very flat or very quiet, then there is no reason for banks to change their mortgage rates that frequently. So you might have already guessed a little bit that bond market is free floating, meaning that it changes every day and it's changed by investor sentiment, economic data. You can see those moves are very fast. Now, Bank of Canada has nothing to do with the changes in the fixed rate mortgage market. And this is a very common misconception a lot of people have. They think that the Bank of Canada is changing all kind of mortgage rates. It's actually not true. The fixed rate mortgage market is purely driven by the bond yield. Whatever term you're looking at, and you have to look at the same maturity bond, and you have to look at their price action, and you get the price for the fixed rate mortgage. It has nothing to do with the Bank of Canada's decision. It is independent of what the Bank of Canada is saying. On the other hand, if you go to the variable rate mortgage market, then it's all about how the Bank of Canada is changing its policy rate. Bank of Canada meets 8 times a year and gives announcement on their overnight rate. That overnight rate is going to dictate what the prime rate the bank sets for their variable rate mortgages. Now let's take a look at how the variable rate mortgages are impacted by the policy rate decision. So from the chart, you can see this data goes back to 2020, and you can see that the variable rate mortgage for 5-year term is directly linked with the prime rate. So in this chart, the red line is the prime rate, and as of today, the prime rate is 7.2%, whereas the average variable rate for the 5-year term is 6.97%. So basically, there is a negative spread for the banks, and you might be wondering why there is a negative spread. Why not a positive spread? So the reason for that is even though the prime rate is 7.2%, the bank is not actually acquiring those funds at 7.2%. They're actually acquiring those mortgage funds at much lower cost, and that's why the spread is negative in this case. Let's take a look at how the prime rate has changed over the last 50 years. So this data goes all the way back to 1970s, and you can see from the chart during the 80s and 90s the prime rate was almost 20% because at that time the inflation rate was so high. So if you talk to any elderly person who got their mortgage back in the 70s or 80s, they will laugh at today's rate because they experienced 18% mortgage rate or 15% mortgage rate on their first property. So the fact that the mortgage rate has gone down significantly over the last 30 years and people are more comfortable with this low interest rate mortgage environment. And that's when, even if we see a 5% rate, this rate seems very high for a lot of people because they haven't seen any historical data and they don't know that at one point in the history, the prime rate was actually 21%. I'm not suggesting that this is going to happen again, but this is just a fact that happened in the past. We don't know when it might happen again. Now, in this chart, this is an example of how both the 5-year fixed and 5-year variable mortgage typically go in tandem. And you can see that there are some times when the interest rate can be a little bit divergent. So back in 2008 and 2009, you can see there's a big spread between the variable and the fixed rate mortgage. And beginning of 2022, you can see there's a significant gap between the 5-year variable and 5-year fixed. As I already say, 5-year variable follows the Bank of Canada's decision, whereas the 5-year fixed or other fixed mortgages follows the bond market. So if the bond market is already anticipating a recession or a correction in the economy, they automatically price in those information in their bond yield. So bond market reacts quickly, whereas the Bank of Canada reacts very slowly because they are the regulator. They can't change their mind every day. So they have to look at a lot of data, and that's why they're slow to react to changes like what happened in 2023 and what happened in 2022. I hope that this video brings a little bit of clarity how the mortgage market works and how the fixed rate mortgage and the variable mortgage gets priced. And if you have any question, please let us know in the comment section. If you like this video so far, please subscribe to our channel and like this video and share this video with other people who might have a question about mortgage rates. See you in the next video.